Chris Wood joins us right now, Jefferies Global Head of Equity Strategy, joins us out of Tokyo, a cheaper Tokyo than usual, Chris, given, of course, the exchange rate, and I'm sure, of course, your Hong Kong dollar, your U.S. dollar goes a little bit of a long way. We'll get to the yen in just a moment here, but just given these fairly adverse investing conditions, are you bullish on anything right now, Chris?
Well, yeah, no, that's clearly right now it does remain almost the inverse of Goldilocks in world markets. We have a Fed monetary tightening and we have the rate hikes, but we also have the balance sheet contraction getting more underway in terms of quantitative tightening. And in a funny kind of way, the rally over the summer months, which was driven by the peaking out of inflation narrative, has delayed the end of Fed tightening, because Powell definitely talked more hawkish at Jackson Hole because he miscommunicated in July at the FOMC meeting and gave an unintentionally dovish message. So he's now had to reiterate the hawkish message. Yeah, so in the short term, it's bearish, and September and October are normally when you get markets going down sharply.
We had Deutsche Bank saying, look, it seems like investors are unwinding their equity positions as if the deep recession has already arrived. What signs are you looking for, Chris, on where and when we're going to reach that equity bottom?
When the deep recession already arrived, the Fed would have done a U-turn. So the problem is that the labor market data is not that weak yet. It's just starting to weaken. And the last employment cost index in the U.S. showed record gains in terms of wages, which is why the U.S. economy remains more resilient. So I'm sure the U.S. economy is going to continue to slow in coming months. But the recession is not going to arrive that quickly, which means that the Fed tightening can proceed for longer. So one key issue for me is the politics. In my view, 50% of the reason Jerome Powell turned so hawkish from last November was political pressure on the Fed to get in front of inflation, because the Democrat administration, moderates and Democrats in Congress, suddenly realized fourth quarter last year that inflation was a #1 issue on Americans' minds in terms of opinion polling data. But as important politically, the opinion poll data showed, rightly or wrongly, the Democrats, the Biden administration, were being blamed for the inflation. So the message went out to do something about this inflation. So this is the first time since the 70s we've had political pressure on the Fed to tighten. That remains the case today, but maybe after the midterm elections, that pressure goes the other way.
So, Chris, right now, into the elections, maybe into the end of this year, what is the investment advice?
Well, you can't have an investment advice at the end. The key point for now is you want to own my key favorite sector in equities remains what it's been for the last 2 years, and that's energy stocks.
Why stay bullish still? Of course, there's this whole cost of living crisis. Does it only drive you more into the sector, Chris? I mean, that was kind of one of the key performers in the first half already.
Yeah, no, energy's done very, very well, but I want to have energy stocks because as a fundamental hedge, because the obvious risk to energy stocks is demand destruction caused by slower economies. Energy stocks have corrected on that demand destruction theme since the highs in about June. But the reality is that there's not much evidence of demand destruction in the Western world for energy as of today. The only evidence of demand destruction on energy right now and oil is in China. So in that sense, actually, President Xi is doing the rest of the world a big favor, because the oil price would be materially higher today if China was fully reopened, and the inflation scare would be that much worse. And the Fed now has to focus on headline inflation, not just core inflation. So I definitely want to remain invested in energy stocks because of massive supply constraints in energy caused by the attack on fossil fuels in the last several years, which has had the unintended consequence of causing a collapse in investment at a time when 82% of world energy demand in 2021 was still met by fossil fuels. The other reason to own energy is quite simply that you need a hedge against the growing risk of escalation in Ukraine, and markets have currently forgotten about Ukraine.
Yeah, but every day reminding us that it is still an important story, to your point there, Chris. I mean, Chris, I want to ask you about Japan. You're in Tokyo right now, and usually 99% of the time, a weak yen is positive for the equity market. Can we follow that sort of indirect rule at this point in time, or is now a time that it's not as useful?
No, it's a very good point. No, the historic correlation between the weak yen and positive for Japanese equities has completely broken down this year. Historically, what happened was foreign investors would buy the Japanese equity market when they saw the yen weaken. That was the explanation for the correlation, but that is completely broken down. And the other problem with the Japanese stock market remains what it's been for many years, is that domestic institutions have not reallocated money to Japanese equities since 1990 when the bubble peaked. So the Japanese stock market has a problem unless foreigners are buying. The fundamental cause, though, of the collapse in the yen this year is the stubborn commitment by the BOJ governor to this yield curve control policy, which in my view doesn't make any sense. But so long as US bond yields are rising, which they are right now, and if the BOJ is trying to maintain this 25 basis point target on the 10-year JGB, the yen's going to keep going down. The consensus in Japan, because I've been here a few days, is that Kuroda will keep this policy in place until he steps down next spring, even though more and more people inside the Japanese central bank are uncomfortable with it. And that's probably correct. But in my view, if the yen breaks 150 and inflation in Japan starts moving north of 3 towards 4, then I think it will become even difficult for Kuroda to maintain this policy line. But fundamentally, the policy makes zero sense. It's destabilizing the yen. It's causing the BOJ to buy ever more ridiculous amounts of JGBs. And it's causing a huge imported inflationary pressures in Japan. And Japanese households have very little wage gains to compensate for it.
Yeah. And how does it impact, I guess, earnings, right? Should I expect earning revisions to continue on the downside for a few more months, Chris? And is the earnings threat a bigger one than the Fed itself?
No, I think the biggest problem in Japan right now is this yield curve control policy of the BOJ. I think it's completely counterproductive.
Right. Now, final questions, Chris, while we're talking about earnings. So I'm looking at multiples, say, MSCI China. You look at the U.S., for example. One part is earnings, obviously. The other part is, what discount rate do we use? Do these valuations make sense to you, given we don't know where the Fed's going to go with the terminal rate?
Well, I'm not sure whether, To me, there's no point making long-term predictions on interest rates because every prediction made by the Fed in the last several years has been wrong. I think that we just take one FOMC meeting at a time. And for my guess for the next FOMC meeting is a 50 basis point rate hike. But if you look at price to sales in the US, it was, and I had the chart in the presentation I gave this morning, we are still way north of the highs of the levels reached at the peak of the 2000 NASDAQ bubble. So on a US basis, you still have extremely high valuations in the growth sector. So if monetary tightening proceeds, US equities can definitely go lower. The problem for the rest of the world where valuations are much more reasonable, Japan's a good example, is that so long as they remain correlated to the Wall Street, and Japan's completely correlated to Wall Street right now, they can get cheap. China's been dirt cheap all year. The big problem for myself and everybody looking at Asian equities this year is at the start of this year, China was the obvious hiding place because China, by October, November last year, had commenced monetary easing, fiscal easing, and property easing. China, unlike most markets, was not negatively geared to Fed tightening. So people naturally moved money into China. If I was a fund manager, I would have done the same thing. But obviously, that whole bet has backfired spectacularly because of this continuing commitment to COVID suppression policy, whereas many people were hoping, myself included, that the COVID suppression policy in China would be adjusted for the practical realities of the Omicron variant.